Greetings, everyone. Thank you for joining us today. We've got an exciting session lined up where we'll be discussing important aspects of the IRA, Inflation Reduction Act, particularly on the ITC, the Investment Tax Credit, and the Domestic Content Bonus. The speakers will include myself and Liz from SolarEdge, but we're very excited to also have Novogradac to join us to explain this important piece of legislation. Novogradac and Company is a national professional service firm that works extensively in the renewable energy industry, providing services to stakeholders in understanding and interpreting the tax impacts of the ITC, and specifically for this webinar, the domestic content adder. Novogradac is an independent service provider unaffiliated with SolarEdge, and we're happy to have them join this webinar to provide information on these tax topics. Some housekeeping items before we begin. You'll be muted throughout this presentation, but you can submit questions throughout using the Q&A section. We'll answer them at the end of the presentation and also via chat. If we do not get your questions today, we'll be reaching out via email to do so. We'll also be sending the webinar content via email and posting on media outlets. First, I'd like to introduce our speakers for today. Joining is myself, Kleber Facchini, Director of Product Management for Community Commercial Industrial Products at SolarEdge, Liz Reichertz, who is our Global Head of Government Affairs, and Josh Morris, who is our guest speaker from Novogradac. Josh is a partner at Novogradac, who specializes in providing accounting and consulting services to the renewable energy tax credit community. Josh provides financial modeling, financial statement audits, and tax compliance and consulting to his clientele. It's great to have you both here, Liz and Josh, and thank you very much, Josh, to join us here to talk about this very important topic. Let me quickly walk you through the agenda for today. Josh will start by explaining key items of the Inflation Reduction Act, more specifically on the ITC and the domestic content bonus credits. He will explain what it is, eligibility, and how to achieve it. Liz and I will then explain the SolarEdge domestic content products and how to achieve the domestic content requirements with readily available products. And we'll finish the session with a Q&A session, right, and discussion on how SolarEdge and Novogradac can help you on this important topic. With that, I'll pass that on to Josh, where he will explain to us the legislation as well as ITC and the domestic content bonus adder.
All right. Thanks, Kleber. Appreciate the introduction and really appreciate the opportunity to join this webinar today. The domestic content adder has indeed been a very hot topic for us really since the IRA has passed, and we've been really excited to really be a key player in helping folks understand the rules and be able to do some due diligence around that ITC adder, along with all of the issues that the investment tax credit presents. I'm excited to be talking about that with you guys today. So we're going to try to cover ground rather quickly. These certainly are areas that are complicated, and the tax code in this area can be very much complicated. So we're going to talk about what the tax credit is, what the investment tax credit represents for renewable energy projects, and we're going to talk about how to monetize that tax credit. Then once we have really laid that ground level foundational information, we're going to talk about the domestic content ITC adder. What are the rules? What do you need to be thinking about, and how to qualify your project for that adder? So what is a tax credit? I'm sure a lot of the listeners here, you have a renewable energy project, you're building a solar system. You've heard that there's benefits from a tax perspective for eligible costs that you incur. So a tax credit is a dollar for dollar reduction in federal tax liability. $1 of tax credit is $1 less of taxes, which would need to be paid to the government. Renewable energy has been incentivized by these tax credits in two key areas. You have the investment-based tax credit, which is the ITC under Section 48, and then you have several production-based tax credits under Section 45, 45Q, 45V, X, and Z. We're going to spend the presentation really focusing on the investment tax credit. So how much is the tax credit? You receive a 30% ITC based off of eligible costs if you have met the prevailing wage and apprenticeship requirements. There's an additional adder that you can get on the ITC up to 70% if you meet other certain criteria. We'll talk about what those adders are in a little bit here. And so property eligible for the ITC, there's several different technologies as noted on the slide, but we're going to really focus today on solar energy property. So now that we understand the ITC, let's walk through an example. So let's figure that you have a solar array that's worth $10 million in eligible costs. And let's assume that you're eligible for the 30% ITC because you're meeting prevailing wage and apprenticeship requirements. That $10 million facility is going to yield a $3 million ITC. Now let's look at another example where you get the 10% adder for domestic content. That same $10 million build for solar property is going to yield a $4 million ITC with that adder in mind. Now you might think to yourself, well, great, I can get this $4 million ITC. How do I realize that benefit? So the situation for most renewable energy developers, business owners, and real estate developers is that they don't necessarily have a current tax liability to utilize the credits in the year the credit is earned. The tax credit is earned when the project is placed in service for tax purposes. If you can't utilize the credit immediately, you can carry the credit forward for 22 years and you can carry it back for 2 years. This creates a situation where you really want to be able to monetize that credit immediately, and it creates this opportunity for a tax equity investor to be involved or for a business owner to sell the tax credit via the transferability route. So let's dissect that for these two examples. So for a tax equity partnership arrangement, typically you'll see the tax credits get sold at a premium. You bring in a partner that's a third-party investor that has tax liability. They'll invest into the partnership arrangement at that premium pricing. They get the tax credits out of the deal, and the sponsor receives that capital contribution as a part of the capital stack. So for the 30% ITC example, that would be a $3.1 million contribution of tax equity at a $1.05 pricing. For the 40% ITC, that'd be a $4.2 million tax equity contribution. Now, tax equity arrangements can be quite complicated. We could spend a few hours really dissecting and talking about the nuances of tax equity partnership arrangements. So some folks are really excited about the transferability option that came into play with the Inflation Reduction Act. Transferability allows you to sell the tax credits generated to a third party for a cash purchase. Now, unlike the partnership arrangement, typically the transfer of the tax credits is going to be at a discount on the dollar. So let's just assume 90 cents might be the pricing for which you can sell the credits through transferability. Under the 30% ITC scenario, you're looking at a $2.7 million transfer price that you'd receive in cash, and then the 40% ITC scenario gets you $3.6 million. Either route you take, whether it's tax equity, which is the more complicated route, or transferability, which is a little more simplified, that creates a very large amount of your capital stack to develop your project. Between 30 to 40% of your capital stack could be made up of monetizing these ITCs. So let's move forward and let's talk about a few of the options that the IRA presented. So the IRA has extended the tax credits to where the ITC is going to be available through 2032 at that 30% base rate, assuming prevailing wage and apprenticeship requirements are met. Then it begins to phase down through 2035. So that's very exciting that there is this 10-year runway from the time the IRA was passed to really transact on these projects. In addition to offering extensions, the IRA has provided us with these adders, these bonus credits. So not only do you have 30% base for meeting prevailing wage and apprenticeship, you have the ability to get additional ITC value. Number one would be the domestic content ITC adder. We're going to talk a little bit more about what that criteria is, how to qualify your project for that. In addition to domestic content, you have the energy community adder. And then you also have either a 10 or 20% adder available if your project is located in a low income community or on Native American land. And then you get an additional 10% on top of that if that project is associated with an affordable housing project. So if you meet every one of these adders, you could get up to a 70% ITC, which is a percentage of your eligible cost basis. So let's dig into domestic content. Let's talk about exactly how a project would qualify for domestic content. So as mentioned, you get a 10% or 10-point adder if you meet the domestic content criteria, and that's not only for the ITC, but it is also eligible for the PTC. So how do you go about meeting these requirements? There's really two criteria. Number one, 100% of the structural steel and iron must be manufactured in the U.S. That's pretty straightforward. So the second criteria would be the adjusted percentage rule that specifies under the IRA, starting at 40%, the manufactured products must have been mined, produced, or manufactured in the U.S. I'll actually pitch this over to Liz, who is really close to policy matters on this, because I know there's a little bit of confusion on how this rule might be changing and increasing threshold from the 40% for the ITC.
Yeah, thanks, Josh. I'm happy to jump in. So, the way that the law was written, the production tax credit, or 45Y, does escalate by 5% each year starting in 2025 until it gets to 55%, and then is at 55% through the life of the credit. However, for the investment tax credit, the way the law was written, there was a congressional drafting error. So under 48E, the 40% requirement for domestic content actually remains at 40% through the life of the credit. But it is important to note that this was, like I said, this is a congressional drafting error. They know they made this mistake. Treasury doesn't have authority to fix it, so it would have to be congressional action. And I think that the majority of folks believe that Congress will go ahead and make that legislative change. And so most companies, from a risk mitigation perspective, are going ahead and planning as if the ITC will increase by 5% year over year, starting next year with 45%. And when it really gets to my turn, I'll explain why that's okay, because actually with SolarEdge technologies paired with racking, we can get to there anyway. But I'll turn it back to you, Josh.
Thanks, Liz. Yeah, and that's right. So for the most part, we're advising our clients take a conservative approach, although there's clarifications needed. We're advising our clients to be conservative as that escalates by 5% each year, to try to plan for that as you look to meet your domestic content criteria. So the specific guidance that we'll be talking about here would be the original notice 2023-38. That provides a direct cost approach for meeting the manufactured product test. And then we have the additional notice 2024-41 that provides an elective safe harbor approach, and really did help to simplify how you can meet the criteria. So more on these two criteria that are necessary to meet domestic content. The structural steel and iron has to be 100% made in the U.S., and that is structural in function. This does not include subcomponents like nuts, bolts, washers, wire, etc. And specific to Table 2, that is in the original notice for a ground mount solar PV, we're talking about steel module racking, pile or ground screw, and the steel or iron rebar in the foundation. So that's the first criteria. The second criteria would be on the manufactured products. You're really looking at 3 layers here. Number 1 would be the manufactured product that must be manufactured in the US. Manufactured products would be things like the modules, trackers, inverters. Then you have to go 1 layer deeper. The components must also be made in the United States. And in the original notice, Table 2 offers examples of exactly what those components are. But really think to yourself, there are components within a module, and each of those components, if you're going to count it towards this adjusted percentage rule in the numerator, then those must have been made in the US. Subcomponents, that's a layer deeper. The guidance did make it clear that that can be made anywhere. You don't have to dig deep into the subcomponent level. So let's walk through an example. That's all very complicated. What exactly is this adjusted percentage rule? So the adjusted percentage rule is based on the project's total direct material and direct labor costs of the manufacturer. There has been a lot of confusion in the industry about that very statement. A lot of my clients will call me and ask and say, well, so we're calculating the adjusted percentage off the cost we incur, right? And I'll kind of let them know that unfortunately this test is at the manufacturer level, and so you're performing this 40% test off of the cost that each vendor is incurring to manufacture their product, not the cost that the developer is paying to, say, buy the modules, to buy the trackers. And then another misconception is where the test is performed. So the test is performed on the total project's material and labor and not performed at each component level. Sometimes I'll have clients reach out to me and they'll say, well, you know, the modules, we don't have any components that are made in the US, but we have a lot of other domestic components. Do I fail this test because I don't meet the 40% test on the modules? The answer to that is no, that's not the case. If you're able to get the math to work in total for all of the manufactured products, then you're able to satisfy the adjusted percentage rule. So let's look at a quick example here. Let's assume that the project has 2 applicable project components, the module and the tracker, and then in the chart you can see the various manufactured product components. Let's assume that the cells are not made in the US. So that $350 cost to the vendor would only go in the denominator for this adjusted percentage calculation. Let's assume the frame, junction box, and glass, those are all made in the US. That would go in the numerator. And then the tracker, let's assume that all of the costs related to the tracker for the vendor are also made in the US. Those will also go in the numerator. So we're looking at, by way of math, $280 is domestically manufactured. That goes in the numerator. 680 total cost to the vendor. In the denominator, 41.17%. The adjusted percentage rule passes that 40% test. So as you can see, that it's very complicated. And one large criticism of that adjusted percentage rule is that you have to look at the direct costs of the manufacturer. It's really difficult for developers to get that information. There's ways to go about it using a service provider like Novogradac or a consultant to help obtain that information, prepare a report on it. But it's still a little bit awkward to try to get that information. And so the IRS, heard the criticisms, heard the complaints, and followed up with this new elective safe harbor approach via IRS Notice 2024-41. So what this approach allows you to do, there's these default percentages in this Table 1 guidance for each component of the manufactured products. And this table has been separated for ground mount facilities, tracking and fixed, and rooftop facilities, MLPE and string. And so the goal here would be that you would understand and identify with your vendors what components are made in the United States. And then you're able to work out the math based on the Table 1 guidance to figure out if you get over that 40% adjusted percentage rule. Now let's walk through an example to maybe play that out a little bit further. So under the new elective safe harbor approach, let's take an example where the developer doesn't know if the module or any of its manufactured product components are made in the US, but they were able to receive certifications and receive an understanding from their inverter manufacturer and their roof racking manufacturer as to the nature of the components. So looking at the inverter, let's assume that all of the components are made in the US. The PCBA, the electrical parts, the enclosure, those items are made in the US. And because all the components are made in the US, you get that production bonus. So in the table 1 chart, you'll see the production line is bold. You're able to get those points if every component of the manufactured product is made in the US. So in that example, the inverter would generate 35.6 points. You're almost there. You're almost to 40. So then the developer reaches out to the roof racking manufacturer. They come to an understanding in example 1 that the rails are made in the US, the fasteners are not. So you're not able to get that production bonus, but 35.6 plus 8.6 gets you to 44.2. You're passing that 40% test. Now, example 2, let's assume that escalation happens. You begin construction on a project in 2025. You're taking a conservative approach. You really want to get over 40. So a way to get there, your inverters are all manufactured in the US, 35.6 in all of the components. And then if the fasteners are also made in the US for non-steel roof racking, that gets you 11.1 and the 6.1 production bonus, 25.8 on the non-steel roof racking. That gets you to a total of 61.4. So you're well above the 40%. And what's exciting about that is you haven't even dug into the PV module components. You may even have more components there that are made in the US, but this gives you a path of getting to the 40% just by looking at inverters and roof racking. So at this point, I'll hand it over to Liz and Kleber, who I know are chomping at the bit to talk about a few aspects that are important to them and that they want to share about the domestic content bonus.
Thank you, Josh, and thanks for doing all the hard work in terms of walking through the technical aspect, because that's the toughest part, right? So Clever and I get to come in now with the fun part, which is to say, how do you actually get there with SolarEdge technologies? We clearly do have a path to help you get to that 10% domestic content bonus. So I will move on to the exciting pieces here. And this is just to say that we have been working really hard to meet these manufacturing milestones in the US. So because of the Inflation Reduction Act and because of those different credits, in order to help our customers, while we are a leading global manufacturer, we didn't have US manufacturing before. Now we do. So because of this, we've been able to, and in very short order, bring manufacturing here in 2023. We started manufacturing out of Texas, our home hub inverters, and by 2Q this year, we were about 50,000 per quarter. We're actually now around 60,000 a quarter. In Florida, we've now been able to open manufacturing there, and we started manufacturing this year. Started shipping power optimizers in July, and we expect to get to about 2 million power optimizers per quarter by first quarter of 2025. But the exciting piece for this audience is to share with you that we will also be manufacturing now C&I inverters in Florida, and we should be at about 2 gigawatts a year in early 2025 and be shipping those as well. So we've added around 1,750 in terms of new employees across the US, and we are going to continue to grow that. And I'll just make a side note to say that I've been both to our Austin, Texas facility several times now and just got back with Clever from Florida. And it's just really amazing, amazing site, and we would love to host you there. So Josh walked you through the new safe harbor or the elective safe harbor table. So to be really specific on SolarEdge for our CNI customers here, when you look at that table under the rooftop MLPE, that's the category that I'm talking about here. And so when you do pair those power optimizers and CNI inverters that we're going to be manufacturing there in Florida, pairing those together, we can get you to 35.6 percentage points because we are manufacturing in the US the printed circuit board assemblies, the electrical parts, the enclosure. And then as Josh said, with all three of those, that then allows us also to get you the 16.4 for the production. And so therefore you're at 35.6 percentage points. So I'm going to go ahead and turn it over to Kleber so he can walk through the actual products with more specificity, and then I'll come back on for the Q&A at the end.
All right. Thank you, Liz. Thank you, Josh. Very great. I mean, I appreciate you folks walking through the legislation, walking through the pieces, right? I mean, the technicality on how to achieve the bonus credit, and how I have 4 slides here where I'm going to be presenting the lineup of products that we're going to have, that we're going to be producing here for the US in terms from a CNI perspective, as well as I mentioned, talking about how you can actually get, right? With products that are readily available or soon to be available from a perspective of inverters and racking, okay? So to start with just a quick slide, here's the lineup of CNI domestic content inverters that are going to be manufactured in Florida, start shipping in March 2025. We're going to have the same inverter models, right? That we currently have. And we're actually kind of making even easier because we're reducing the number of SKUs and the number of part numbers, okay? So, and we're going to have, there's going to be one part number for 10, 17, 3, 30, 40 kW inverters, one for 80 kW, and one for 50, 100, 110, and 120 kW Synergy Manager inverters. And also from, we're going to have 2 optimizers, one for RSD compliant optimizer for like rooftop, for instance, and one optimizer whenever there's no need for rapid shutdown, for instance, like for carports, okay? So next slide, please. So having talked about the details of the legislation and the ways to claim the credit, I'd like to discuss briefly the paths to achieving domestic content and what we're seeing in terms of product availability in the market. There are several questions with regards to product availability and the premium for domestic content products. So let's look here at 4 paths. I know that there are several, but I picked 4, so that you can walk through here, especially because of the questions that I'm getting from customers and even from our internal team, okay? The first 2 paths are modules only and modules with racking. Both are virtually impossible, or I would say very tough, because there is almost no availability of solar modules with domestic content. And when there is availability, there is a price premium of about 15 to 20 cents a watt. The concern on module availability is also made worse as the domestic content production for modules is being targeted for ground mount applications, where the contribution of modules towards the domestic calculation is much higher than for rooftop. Okay, so that's based on the safe harbor table that Josh presented. Another path is string inverters plus racking. Using the rooftop string column of the safe harbor table, the combination string inverter plus racking adds to up to 44.6% if both, right, of the inverter and the racking, they meet the domestic content criteria, okay? But as Josh and also Liz explained, right, previously, the domestic content threshold for the ITC remains at 40% due to a drafting error in the law unless there is a change. But we are hearing that customers are planning for a domestic content level higher than 40% for risk mitigation in case the law is changed, and where the level will increase by 5% year over year until it reaches 55%. So that's what Josh was explaining, that even he counsels, I mean, he guides his customers, right? I mean, his clients to not account to 40%, but to assume that the level, the threshold will be growing as we have today for the PTC, okay? And the last path I show here is achieving domestic content with inverter plus racking using the rooftop MLP column. The contribution of both can be up to 61.4% if inverters and racking are full domestic. As Liz mentioned, SolarEdge inverters will be fully domestic made by March 25, and therefore able to contribute 35.6% towards the domestic content calculation. I'll show next that there are several racking systems that already have or will soon have full domestic content, contributing 25.8 towards the calculation. The advantage of this path is that the price premium for domestic content products or for domestic products is estimated to be around 2.5 cents a watt for the combination inverter and racking when compared to present domestic solutions. So the combination of SolarEdge C&I products plus racking provides the least expensive and readily available path for project owners to achieve the domestic content bonus credit in their projects. To better illustrate what I just said, I show here the domestic content calculation via the safe harbor table rooftop MLP column when using SolarEdge inverter system in a full domestic content racking. Last week, I presented a webinar with PanelClaw on this topic, and we explained that PanelClaw C&I racking is readily available with full domestic content. When using this path to achieve the domestic content bonus credit, project owners and developers will be able to achieve 61.4% domestic content level and therefore meet the minimum threshold to claim the added bonus. This is again because SolarEdge C&I inverters contribute to 35.6%, and the racking system, for example, PanelClaw, contributes to 25.8%. Okay, so again, the combination of SolarEdge C&I inverters and racking provides the most cost-effective and readily available path for you to achieve the domestic content bonus credit. The previous slide, I mentioned PanelClaw, but there are several racking products that are readily available that meet partial or full domestic content. Here, besides PanelClaw, I'm showing Unirac, Iron Ridge, Opsun, and NAS5, right? That all have products that fit into this category. And I got this information from racking suppliers, right? I mean, with authorization from those folks, so that we can show you to and provide to you that path, right? I mean, with inverters plus racking. We're planning webinars and combining material with these leading suppliers, right? We're already presented with PanelClaw, and now we're going to have within the next month webinars and combined materials with these folks as well. And to finalize, I just want to make sure, place your orders today, right? I mean, like with the SolarEdge, we're ready to get orders to start shipping in March 2025. Okay. With this, I will start with Q&A. I see that here in the chat box, that there are several questions that came, really good questions. You know, I mean, I was monitoring here while I was listening to Josh and Liz. Great questions. So, and we have some time here, and I mean, to go over the questions. So I will start, actually, I mean, I will start with a question that, two questions, I think, actually, that are very related, that's in everyone's minds. And I'll turn over, actually, Liz. So to you, first question here. Are you expecting further guidance on domestic content from the IRS? And if so, when?
Yeah, great question. So yes, we know, there's a few portions of the implementation for the Inflation Reduction Act that haven't been finalized yet. That does include the PTC and the ITC, so 45Y and 48E. Our understanding and what we've been hearing throughout the industry is that administration is pushing hard to get those rules finalized by the end of the year. And then with regards to domestic content, the administration has also signaled that they may update that table by the end of the year with some tweaks. I know there's been different folks talking with the administration about some small changes that they're hoping to make within that domestic content safe harbor table. So
Very
we're
good.
hearing for now.
All right. So another question that we have here that we're getting, actually, it's in everybody's mind. It's with regards to the election results, right? So based on the election results that we just had, right, and I would like to open the floor for Liz and for Josh. Does either of you, expect any changes or any possible changes due to the results that we had in the election?
Yeah, great question, Clever. Josh, do you want me to go first or you want to take it?
Sure, Liz, you can start us off.
Okay. So it is a great question. I know a lot of people are really thinking about this and having a lot of different discussions to understand what the implications may be. I would say specifically for those provisions that we were talking about today for the ITC and domestic content, the investment tax credit has been around for decades actually, and has been extended by Democrats and Republicans alike because they see that it really has had a very positive impact to our economy. And I think that we still have bipartisan support for the ITC. On the domestic content piece, it's really been a multiplier in terms of what that's meant for investments in the US. And when you look across the country, in almost every state, you're seeing massive investments, particularly from our industry, as we bring manufacturing back. A lot of it's onshoring or creating new manufacturing. And so we're seeing jobs in enormous numbers, including what I described in terms of our Florida activities and our Texas activities, which we're really proud about. And I think I'm going to tie one more piece to this, which is the manufacturing credit. So we're getting a manufacturing credit for opening these manufacturing sites, but we are also helping our customers with the ITC and the domestic content. So it's not just the inverter, as you heard us talk through, of course, for domestic content. It's the inverter, and then we're also manufacturing those components that help our customers get to domestic content. And I think that story certainly resonates with both Democrats and Republicans alike across the board. But we will continue to talk to the new members as they come in and educate them, and certainly continue to talk to the new administration as they come into Washington as well. But Josh, let me turn it to you if you want to add anything to that.
Yeah, great summary. I agree with all of your thoughts there. I certainly agree that there's history of the ITC, PTC being bipartisan. Both sides of the aisle have supported these incentives, and especially when we talk about domestic content, I very much think that this new administration is focused on manufacturing in the United States. The advanced manufacturing tax credit and the domestic content adder, I very much expect to be favorable items in the eyes of the new administration. What happens with the Republicans holding all three branches? A lot of uncertainty there. The Inflation Reduction Act was passed in more of a partisan manner. And so I do think there will be a look at it, but given that the Republican control of the House is in the margins, I think it takes a lot to really pass wholesale legislation to change what guidance is there with the Inflation Reduction Act. It'll all be very interesting to see how it plays out, but I'm generally positive minded about the direction that things will be going, even with the results of the election.
All right, very good. Thank you both. Great answers, and we're looking forward, to kind of seeing. And also, I agree with comments that from both of you. I have lots of questions that's coming here, but one of the questions from I think for SolarEdge is will there be any issues meeting demand for the domestic content products and optimizers in 2025 and later? So I'll take that one. As Liz mentioned, right, there are capacity plans for a Florida facility for both inverters and optimizers, right? That means north of 2 gigawatts a year, and that's more than demand that we have today. So we actually were doubling, right, our capacity in order because already we are expecting that there will be an increase in demand for domestic content inverters and optimizers. Okay. Josh, I'll turn over to you. There are two related questions here. Okay. With regards to eligibility, right, of customers. So I think it's a customer, it's a small business owner. And the person is asking, I'm an owner of a small business and I want to install PV on my roof. Will I be eligible for the domestic content adder bonus?
You might be. You'll have to do the analysis that we talked through. But certainly there's opportunity that there's plenty of paths to be eligible for the domestic content adder. You just need to do the diligence, do the work to figure out if you're meeting the tests with regard to the steel and iron requirement and with regard to the manufactured product test. So I hope that your project qualifies. You have to do some analysis to determine if that's the case.
Sounds good. So how about then there's actually a related question about eligibility for nonprofit organizations like schools and municipalities.
Really good question. So we talked about the ITC. An owner of a facility earns an ITC, and that ITC can be monetized, right? Or consumed by that business owner if they have tax liability. For nonprofits, they don't have a tax liability. So great question to wonder, how does this apply in that situation? The Inflation Reduction Act did create a path for nonprofits. It's called elective pay. And under elective pay, you're able to receive, a grant proceeds basically for the amount of the ITC. You don't have a tax liability to offset it against, but when you work through the filing for the elective pay path, you're able to get actual cash proceeds for the value of the ITC.
All right, very good. So this one, I think, Liz, I'll pass that on to you. What documentation is available to customers to prove the domestic content levels of our products?
Yeah, great question. And we're working really hard to make it easy for our customers. So we've got a couple of things. One, we have a certification letter where we walk through exactly what we shared with you here today in terms of what components we're manufacturing and where those are manufactured. So that's step one. And then if you enter into a PO with us, then we actually have additional documentation that we'll be able to share, which is a legal opinion from an outside law firm, confirming what we're saying in terms of our manufacturing. So I think those two combined are pretty powerful from documentation side coming from SolarEdge.
All right, very good. And then Josh, just I think we touched upon the documentation that the equipment supplier provides, right? And then what role does Novogradac play in confirming the domestic content levels for my project, which is like the customer asking, right? So what role that you play on that?
Yeah, so we're excited that we offer service in this area where we can perform due diligence around all of the criteria that we're talking about. We offer what's called an agreed upon procedure report. So this is where we perform specific procedures agreed to with our client, which is oftentimes the developer of the system. They want to qualify their project for domestic content, and we will perform procedures really obtaining the evidences and obtaining the support for the criteria that we talked about. There's two paths, right? There's the direct cost approach, and then there is the elective safe harbor approach. The direct cost approach, we offer a role where we can work with the vendors through an NDA, get their direct cost information, and aggregate all of that while working through a report for the benefit of the developer and the investor to work through all that math that we talked about with that 40% test. That path is a little bit complicated, but we're excited to offer that type of a service to help folks get comfortable with the results. Then the elective safe harbor route, very similar. We're able to do some diligence around the facts supporting the criteria. It's a little bit easier. We don't have to play the middleman with the vendor, but we're able to get from our clients evidence supporting that those manufactured products are made in the USA. And then we would generate a report that goes through the findings of what we received, what evidence did we look at, and go through the math on that manufactured product test. On the steel and iron, again, we can do the same thing. That's not a mathematical test, but really holistically, all the structural steel and iron needs to be made in the U.S. We obtain and collect evidence that's available to our clients to, list the findings that those items indeed were manufactured in the U.S.
Okay, very good. And then a related question that I can take here is that will SolarEdge support customers who want to use the method, and how does it work? So yes, if there is a need, right, for to go down or to go through that path of the direct cost, we'll provide everything that's needed. We'll support customers. And just from a perspective is that, as Liz mentioned, right, we're fully domestic, when using that, the domestic content is optimized inverter system. You can use 100% of the allowable cost for both optimizers and inverters plus labor on the numerator. All right, so I would say, let's see here. Liz, I think this one is, for you. I think that will be just kind of passed on. That's a customer, right? I'm asking, what is the main difference between the elective safe harbor table and the direct cost method to achieve the domestic content bonus?
You asked it, Clever, as if that's like a simple question. That's like a really difficult question. But I'll point back to, Josh walked through both of these pieces. I mean, clearly the safe harbor table is the simplest methodology because the administration has already predetermined for us what the percentage points are for each of those components. And all you have to do is look through that one column that you're utilizing. We've talked a lot about the rooftop MLPE, so I'll use that again, where you have to just add it up to the required percentage. The direct cost methodology is much more complicated because you do have to get from your suppliers, from those who are the manufacturers, direct costs that we incur, not that you're purchasing it from us, but from a direct cost methodology, and then determine what can be in the numerator and what can be in the denominator. I think the important thing to note, as Clever has already said, is that we are here to help you, and either methodology that you need to work with, we're very happy to work with you to help you get there. And you've got people like Josh at Novogradac who know this inside and out and can help you move through those processes as well. And so I know I didn't answer that in a highly technical manner, but if Josh, you want to add anything to the way that I said that, I know I'm keeping it high level, but you've talked about it quite a bit today.
Yeah, I thought that was well summarized, Liz.
There you go. All right. So Josh, going back to you, you talked about tax transfer, right? Can Novogradac help with the process of tax transfer?
Yeah, absolutely. We can assist there. There's certain forms that you need to file with your tax return. Certain pre-filing requirements need to be made to make the transfer. We can advise you on how to do that. The good news is that transferability route is a bit simpler as compared to the tax equity partnership route. You're entering into a purchase and sale arrangement for the tax credits. And so we can help you as you think through that And also, if you ever needed a cost segregation study to help think through what is the eligible basis of the project and what tax credits are generated, we help with that service as well. Most of the ITC buyers, they want to see that support for what the cost segregation study says for the eligible basis. So yeah, we would love to help folks as they're thinking about their project if they're able to transfer the tax credits and how to execute it.
Sounds good. So then that few questions here, Josh. I mean, just have you had success in helping customers on this process? Have you done this process before with customers?
On the domestic content or transferability?
On the domestic content.
Yes, we've helped a lot of clients in the past year and a half, I would say, where we're working out these due diligence reports on the AUPs, and we've seen several projects. I'm not sure the number off the top of my head, where we've worked out these reports and they've actually received tax equity financing on the domestic content adder. We've helped community solar projects. We've helped utility scale projects, and we've helped residential rooftop developers. And so we're working with several clients that are in the industry that have varying fact patterns. They're going the direct cost route, and they're also going the elective safe harbor route. And we have seen and assisted projects to achieve financing for that ITC adder.
Okay, very good. So I knew that I need to answer that question, so that's why I asked. So thank you, Josh, for that. And then, so the related question is that, so what are the key items, right? I mean, to successfully achieve the domestic content bonus, and what should folks be paying attention to make sure that they get to the domestic content bonus?
Yeah, I would say the key here really is having a solid understanding of the rules, right? And having good practitioners around you to help you think through it. That's number one. And then number two, as you identify for your projects that you're feeling good, that you're going to meet the criteria, you're having these conversations with all of your suppliers, all of the vendors and manufacturers. You have to be in lockstep with them because, as we mentioned on the direct cost route, it's the cost of the manufacturer. So you have to be able to obtain that support or have a practitioner that can navigate that with the manufacturer. So I think it's very key to understand the rules and be able to have open line of communication with your suppliers that you're buying the products from. And then on the elective safe harbor route, again, you need to have good communications with your manufacturers who have to be willing to provide the evidences, right? Because when you're in the throes of diligencing this with tax credit buyers or tax credit investors, they want to know what support you have. They don't want to just hear the statement that, well, I talked to the manufacturer and they said their product's made in the USA. They need to have the confidence that there has been support provided and a third party has reviewed and validated it. So I think the success stories I've seen, it's with my developer clientele that have good relationships with their vendor manufacturers, and they've been talking about it and have a good understanding as to what components are made in the U.S., which components are not. They're able to do the math and have a good understanding on the results. Then they bring us in, and then we're able to, do the diligence and help them get the support they need from an independent third party that the investors can rely on.
And I think, Kleber, probably the most important and last point that Josh didn't say in order to do that would be, of course, to purchase SolarEdge Technologies product that can help to get you there by at least 35.6%. Order your products today.
There you go. All right. No, that's great, Liz. I appreciate that. Thank you very much. Folks, we're getting to the top of the hour here. So to wrap things up, I'm going to open the floor here. I'm going to start with myself and then with Josh and Liz as a last comment, right? I mean, for us to close the webinar here. So just like a few thoughts here, right? I mean, that I start from myself is that I'm getting a lot of questions, right? I mean, from folks asking, hey, Kleber, look, I always thought that for me to achieve the domestic content threshold, I needed modules. So as Josh and I, right, I mean, also Liz, we mentioned is that you do not need to have modules with domestic content level. Why is that? Because inverters, we're going to be starting shipping inverters that have full domestic content starting March 2025, contributing to 35.6%. And then there's readily available racking also with domestic content to get to partial or full domestic, right? That if you get full domestic, you're going to get to 61.4%. So the answer is no, you do not need modules, solar modules to get to the domestic content level. And we explained why. So Josh, do you want to go next?
Sure. Yeah. So this was a fun webinar. I was really happy to be involved here. And one thing I want to just kind of close with and make the listeners aware of. We're excited to be engaged by SolarEdge and also a racking manufacturer install to actually assist with due diligence reports, the agreed upon procedures that we talked about, where we would look at the evidences as to the components and the source of their manufacturing. And that report will work towards listing out the findings as to what we receive. And so we're excited to just announce that, we're helping SolarEdge and install in those efforts. And then we're also excited to help, any of their customers as they're thinking about whether or not their project qualifies for domestic content or any other issues with the ITC, whether that be figuring out if you can transfer the tax credits, how you go about doing that. If you're looking to monetize the tax credits through a tax equity structure, we're very excited to offer our services to you and help you in a consulting manner, in a financial modeling manner, and if you have any other compliance needs that we can help as an independent CPA firm. So we're very excited to be working in this industry. The renewable energy industry is growing so fast, and happy that Novogradac can be at the forefront and assisting with understanding all of these rules and issues.
Right, Liz?
Yeah, I think I'll just say that want to reiterate, we're really proud of what we've been able to do on the manufacturing side here in the United States with the help of our operations team and the way that they've been able to move so quickly in order to help our customers. And we know it's complicated as you move through these things, and that's why we want to be here to help you navigate through and do these kinds of webinars to help you understand and share the kinds of information that we can bring forward to assist you. And that includes the types of documentation that you may need as you move forward with your credits. And so just want to say we deeply appreciate you spending some time with us, and we remain available to you to help answer questions.
All right. Liz, Josh, thank you very much for your time today. And everyone, everyone for that joined the webinar and everyone that's watching this as a recording. I appreciate your audience. And if you have any questions like Liz and Josh mentioned, we are here to help you. We're here to propel this industry forward with this great piece of legislation. All right. So for everyone, have a great morning, good afternoon, have a great evening. Thank you very much.